I'm Jordan, UK Policy Lead for Chainalysis, and I'm here to update you on everything you need to know about the UK and digital assets from the last few months. Today, I'm going to cover some of the updates that we've seen from the FCA, HMT, and HMRC before thinking in more detail about some of the legislative progress with the Financial Promotions Bill and Financial Services and Markets Bill, and I'll then briefly outline some of the developments in the world of economic crime before closing with some thoughts on the broader UK ecosystem. So, starting with the FCA HM Treasury consultation on a regulatory framework for crypto assets, this was breaking news in my February update, but the consultation has since closed. Right now, the government are busy analysing the feedback on their proposals and exploring whether any will need changing. Although I don't have any more detail yet, please do look out for a future update from us where I'll hopefully have the consultation feedback in hand and be able to go through any major changes and what they might mean for the sector and the UK. Now, in news that has just broken as we've gone to record in July, the UK Chancellor announced a consultation on a digital securities sandbox that looks at how to combine digital asset technology with financial markets as part of the vision to secure the future of UK financial services. This consultation has now been released, taking the concept of sandboxes that's long been pioneered in the UK for other areas of financial services to a more technical level than we've seen before. This Digital Securities Sandbox, DSS for short, will be the first under the new Financial Services and Markets Act powers, meaning that we could see different FMI sandboxes established for different entities to test different technologies and different practices and how they might work as part of the existing financial services markets. The DSS will be co-sponsored by HM Treasury, the Bank of England, and the FCA, and it will be intended for already authorised and new entities, and will allow for temporary changes to rules that don't currently allow for tokenised securities to open up testing of financial market infrastructure using digital asset technology. In practice, this will mean that firms will be able to set up and operate financial market infrastructures and, for example, perform the activity of central securities depositories and trading venues. Now, one of the most exciting potentials of all of this is that these temporary changes could lead to permanent changes, meaning that the outcome of a successful DSS sandbox could not only be a successful pilot, but also a permanent modification to rules that will pave the way for more solutions and models to emerge. Now, we're yet to see what this could lead to, but the hope is that it could help overcome some of the sticking points currently preventing tokenization and allow for a range of uses beyond issuances to other uses of tokenized securities, such as posting them as collateral, their use for payments, their use for repo agreements. We're also hopeful that it will help the industry to converge on technical and legal standards, as well as explore not only how their solutions can interoperate with wider FS markets, but how they can operate with one another. The consultation itself will close on the 22nd of August. At the start of June, legislation was laid that extends the financial promotions regime to certain qualifying digital assets, meaning they'll be treated as restricted mass market investments and dealt with in the same way that high-risk investments and their promotions are. This applies to crypto asset firms with UK retail customers from the 8th of October 2023. Practically speaking, it will apply to both UK and overseas firms and mean they will need to add risk warnings, appropriateness assessments, and cooling off periods to their services. Now, this is not without issue, as this last, for example, a cooling off period could be more difficult to implement given the nature of digital asset technology and thus require careful consideration from firms. The legislative change itself also brings something more fundamental to communicate digital asset promotions in the first place, so whether that be on a website, via an app, on social media, or any other channel. Firms will have 4 routes to lawfully communicate those promotions. 1, they need to be authorised for a regulated activity. 2, if they're unauthorised, they must have their promotion approved by someone who is authorised. 3, they must have the promotion communicated by a firm that's registered under the money laundering regulations with the FCA for AML/CFT purposes, or 4, they must have some form of an exemption. Any breach would amount to a criminal offence, which in and of itself means a big operational change for firms from where they are today. The FCA have since published their guidance consultation, which outlines their expectations on firms' promotions of crypto assets, with details of how they can ensure their promotions are fair, clear, and not misleading, as well as additional proposals around cooling off periods, bans on incentives, and how firms can subscribe to these. The consultation is open until the 10th of August. While I hope the next few months are enough for firms to implement the guidance from the FCA, it will place significant pressure on firms as they'll have to assess existing and new promotions, as well as to ensure that they treat existing customers in the same way that they treat new ones. So, for example, they'll need to think about the appropriateness of products and services provided to them. Now, at the end of June, we also saw the parliamentary process come to a close on the Financial Services and Markets Bill, which is now the Financial Services and Market Act, as its provisions and amendments were approved by both houses to become a part of UK law. Now, this bill started as a way to give UK regulators more power over financial services rules inherited from when they were part of the EU, fundamentally giving them powers to revoke, revise, and reform rules as they saw fit. However, it also took on a very digital assets flavour, not only providing a definition of crypto assets that's become widely used across other pieces of legislation and consultations, but also by adding this definition to FISMA, the core financial services legislation in the UK that outlines what should be regulated and what should not. It provides the legal basis and powers for the regulation of crypto assets. It also specifically provides the grounds for a bespoke regime to regulate digital settlement assets that are used for payments, which means fiat-backed stablecoins. Now, to be very clear, the Act doesn't say what these regimes should look like, either for stablecoins or for crypto assets more broadly, but instead it is the legislative groundwork that paves the way for the Treasury, Financial Conduct Authority, Bank of England, and payment systems regulators to introduce secondary legislation that sets these frameworks in place and issue guidance and rules that tells firms what they must do and how they must interpret the rules. So although this is a big step forward, as you can see from how important Treasury considers it, it's still very dependent on what happens next and how quickly HMT and others can move. Rules and guidance may not happen until 2024, depending on how the next few months and the upcoming summer recess impact timings. Now, in the world of tax and HMRC, there are a few things worth mentioning from the last few months. Back in March, the spring budget announced that we should expect a new digital assets category to be added to self-assessment tax forms from 2024 onwards. This will give HMRC more insight into UK digital asset owner holdings and any potential tax receipts. April then saw HMRC open a consultation that considered how to tax decentralized finance, staking, and lending activity. The principal proposal was to not treat each individual staking or lending transaction as a taxable event, and therefore not to apply corporate gains tax to these. HMRC believes this better reflects the economic substance of these transactions. But while relaxing their approach here, HMRC are still planning to treat all returns or interest earned on DeFi transactions as revenue and therefore taxable. Though these are all steps forward in terms of clarity, they could lead to more administrative pain and certainly more taxation for those transacting in DeFi. Now, in terms of economic crime, we've continued to see some real pace and momentum from the UK government since our last February update. And alongside the continued progress of legislation like the Economic Crime and Corporate Transparency Bill, that as of early July has passed the third round of Lords debate, we've seen the UK release a raft of announcements worth covering, such as the second Economic Crime Plan, additional details on the Economic Crime Levy, and a new and updated National Fraud Strategy. At the end of June, HMT announced a review of the AML CFT supervisory regime in the UK, which is currently the only regime that applies to digital assets. Now, having said that these are all worth covering, please do look out for a later update where I'll do just that, as well as thinking about where the UK is headed in terms of its approach to economic crime and what that means for digital assets in more detail. Now, I do want to call out one thing that's worth reminding everyone of in this area. That is the fast approaching deadline for the travel rule in the UK in September 2023. This will mean that digital asset firms, by which I mean exchanges or custodian wallet providers that are registered for AML CFT under the money laundering regulations, will need to identify in-scope transactions and to obtain, hold and transmit originator and beneficiary information immediately and securely on transfers that exceed €1,000. Less information must be collected for transactions below €1,000 or where they are not cross-border transactions. For unhosted wallets, information will need to be collected where the wallet is deemed to be of higher risk. Firms need to consider carefully how this will impact them to ensure they're ready to meet the requirement as it comes in and have the necessary systems to not only identify and collect this information, but also prevent transactions from being completed where any of the information is missing. So, in short, there has been a lot of activity over the last few months, all of which have brought us to a place of greater clarity, with a sense that there is very positive progress across a number of different areas when it comes to digital assets. Thank you for listening, and do please keep a lookout for my next update that will focus on the UK economic crime and digital assets.